this. Let's also bring into the discussion Mayuresh Joshi, Fund Manager at Angel Broking. Freaky Friday it is, Mayuresh. You know, we started off the year with some concerns of LTCG, liquidity issues, crude, rising bond yields, and now this all-out tariff war. One of the sectors that's really, hurt more than the rest would definitely be the metal space after China has imposed that import tariff on some of the US goods. How are you looking at the overall fundamental story for the metal space, which is just about gotten back on its feet and now, clear big concerns creeping in?
Afternoon, Avan. No, clearly I think it's on two counts. So what Trump has done specifically in giving some amount of leeway, at least to the Canadian and parts of the EU in terms of imports, what actually happens with the Chinese imports, which obviously are not that significant in terms of what US imports at this point of time, does create some amount of upheaval in terms of where that excess output will actually head. So to that bit again, the demand-supply mismatch clearly reflects into the realizations for a lot of these metal counters, whether they are ferrous or non-ferrous. The second element in terms of the input cost inflation actually moving higher over the last few months, though it has cooled off. So even if you look at hard coking coal prices, which is ex-FOB China at this point of time, close to $210, $215 odd dollars for the premium one, and with the supply coming in expected to go down, iron ore prices are close to that $68, $70 mark. But again, some push through is required, but with supply coming through on the global scale, difficult to push through, which means that the dent in realizations comes through. For the domestic players, steel players in particular, the volumes have held up pretty well. So even in the last quarter that you saw, the volume growth was significant, the realization growth was significant, the EBITDA per ton also held out for all players on the domestic steel side. Largely again, I think integrated players also should benefit over the longer run. Though I think the headwinds from all the events that are transpiring at this point of time might have some amount of say, but domestic volume should keep on holding up. What you probably might expect in terms of NCLT resolutions of a few steel stressed out assets, whether that adds to the supply over the next few months and probably dampens realizations domestically, is something to be seen. But at this point of time, I think within the entire space, Vedanta is something that I'll still continue to prefer on declines, more to do with the shortage of zinc that we're probably seeing on a global scale. The aluminium business might take a hit with backward integration that the company is planning, and the government's focus in terms of commercial mining should help it and abet it in terms of the longer term earning growth. And the oil and gas business holding up strong balance sheet, and that would probably lead to a very strong earnings CAGR. So selective on metals, I think what transpires will probably have a say in terms of volume growth, but Vedanta probably is something that remains one of our favorite stocks in this decline that we might witness over the next few weeks.
So what's the trend of the market then, Mayuresh? Are you expecting this multi-month correction to just continue into the entire year?
No, so what you've probably seen in terms of trade wars, I think it's not a healthy sign if it becomes a full-blown affair, because what it does, it affects productivity. At the same time, I think the imported inflation probably starts creeping up higher. And the natural tendency for a lot of economies to protect their export market is to naturally, again, devalue their currencies. So I think it again gets escalated into the currency aspect. Global GDP takes a hit, and so will get reflected in terms of the productivity issues. The second element in terms of what Prashant was also mentioning, crude, I think that's an outside joker in the pack. The government had accounted for crude at $55 for FY17. With a $5 to $10 increase as an average estimate, if one assumes for FY18, and though government estimates have pegged that at 57.5 rupees, anything higher than that raises your import bill significantly, and that has a multiplier effect both in terms of your trade deficit, your current account deficit, as well as the imported inflation that comes through in terms of CPI. Inflation actually inching up by 0.3 to 0.5 percentage points. The third element, obviously, which the market would love to see would be corporate earnings. And our own sense is that corporate earnings are showing some signs of recovery, and if they do exhibit that in Q4, you're going to get some amount of respite. The fourth element again is going to be the political scenario based out here in India. and what probably happens with the outcome thereof. Though markets are not affected over the longer term, a sentimental hit in terms of what will happen through if the adverse happens has to be accounted, as well as what happens on the macro front, on the IIP numbers, PMI numbers, GST collections, inflationary trends. So I think there is a lot of sum of moving parts. So our take is that there will be a time correction in the market over the next few weeks and months. The markets might just languish lower and stay lower. So I think that's the time when you probably will value pick certain stocks and sectors where earnings growth looks very, very strong.
Okay, that's the take coming in at the market. As we speak, the struggle continues, so just scratching the surface of that 10,000 mark. 176 points, or rather 176 stocks standing to the decliners right now. And it continues to be the banks within the liquid universe which are really bearing it on the chin. There's IDBI down 6.25%, although it has to be put into perspective that IDBI has also had a big gain year to date, almost about 44% at the peak. You've got SAIL today which is down, there's Syndicate Bank which is down, there's Union Bank which is down. How long, Mayuresh, do you think that this correction in the banks are going to continue? I mean, some of these large banks, and SBI for instance, is already at its 52-week low. How much more pain to go?
I think the pain is still there, Aisha, and what has probably transpired in terms of what is getting reported at this point of time, a lot of the banks might have recognized these as NPAs, but the sentimental hit in terms of higher provisioning that will still take place over Q4 is going to be very evident in terms of degrowth of earnings. Again, I think a large element in terms of the new NPA norms that have been announced by the RBI is also going to take a toll in terms of excess provisioning happening. So I think a lot of the banks are probably going to feel the heat on both counts in terms of excess provisioning actually denting earnings growth. And at the same time, I think with a lot of focus specifically on the PSU banks landscape towards recoveries and upgrades, I think the credit growth itself takes a back seat in this environment because of what you've probably seen with a lot of scams erupt. The third element in terms of yield movement is going to take a hit in terms of the treasury income for most of the banks, and the obvious beneficiaries are going to be a few of the retail private sector banks who are going to go all out in terms of retail advances, and they've got very strong balance sheets to support this expansionary growth. So retail advances growth is expected to remain extremely buoyant, and at the same time, when you're looking at asset quality pressures, they might not be so evident in terms of the PSU universe. So largely I think the onus in terms of shifting of market share gains actually stays with the private financials. Within the private financials, obviously the retail oriented private financials is something that can still do well, and a few of the NBFCs, so a lot of the rural focused NBFCs where the government spend is going to be extremely buoyant over the next few quarters, are going to be clear beneficiaries. You might see some amount of compression as far as their spreads are concerned, but their borrowing mix has also been very healthy and well spread out. So yes, a large element in terms of retail private sector banks and select NBFCs focusing on the rural areas is something that should largely benefit.
You have been patiently listening to all the negative commentaries, be it technicals, be it the market commentary in terms of what's happening in market. Fundamentally also some of the people have thrown in their towels. But what positive thing one should look when it comes to markets from medium to long term perspective? And I'm sure not everything has been negative. What are those positive triggers in this kind of volatile market a fundamental investor should watch out for and increase exposure in this market, if at all?
So Siddharth, clearly I think when all headwinds start being talked about, I think for them to play out in tandem is one probability that does not happen all the time. So in a nutshell, probably I think corporate earnings is going to be a huge kind of a re-rating phenomena for the markets. What we probably saw in terms of Q3 numbers, you did see green shoots across a few of these sectors, and that probably is the theme that Q4, the corporate earnings should start showing visible signs of recovery and improvement. The second angle which also needs to be noted is the government spending. So the front loading of government expenditure, which will happen substantially in the first half of the next fiscal year is going to be extremely critical and pertinent for the markets. So as that happens, and as we've seen some green shoot with a few steel companies declaring expansion plans, I think a few of the private capex green shoots should be visible over the next 2 quarters. The third element obviously is going to be how monsoons are going to pan out, and with the print that we've seen specifically in terms of inflationary trends and the IIP numbers, if those trends continue in the next 2 to 3 months on a consistent basis, though inflation might move up a tad bit to the 5% trajectory that RBI has pointed out, I think markets might still take that with both hands. And the fourth angle obviously is going to be the bond yields. My own take is that the sustenance of bond yields, with all the fear factors that we are talking about, crude staying above 70, GST collections slowing down, I think those fears might just get unwarranted over the next few months, as GST collections will become far more smoother in the next 2 quarters in my opinion, and the inflationary risks should bottom out if it's a normal monsoon. So yes, I think a time correction over the next few months is not ruled out, but as I mentioned earlier, I think the long-term prospects for the economy does look very, very positive. So those time correction periods will give investors a chance to look at qualitative names. So I think one should wait out over the next few months patiently, wait for your prices that will not impact your impact cost in terms of purchases, and go out and buy qualitative names in a staggered way.